I'm Charlotte McLeod with the Investing News Network, and here today with me is Brien Lundin, editor of Gold Newsletter. Thank you so much for joining me here today on the first day of PDAC. Great to see you.
Great to see you after the long respite for a global pandemic.
I know, it's so nice to see people in person again.
Yeah, in 3D. It's amazing.
It's great. And so we have talked throughout COVID. We last spoke, I think, December.
Mm-hmm.
But that's 6 months ago now, and a lot of things have happened in the gold space. Many events just globally that you would think would be good for the gold price. I know many people are wondering why it's not higher. So to you, does this price level make sense?
No, it doesn't. And I have had a number of events, online events, of people asking questions, and everybody says the same thing. Why isn't gold should be hundreds of dollars higher given the global situation, inflation and everything else? So why isn't? And I really don't have a good answer. I have some possible reasons that I give them, but none of them, are really satisfactory. We're all in the boat together, and it's miserable. But before the Fed hiked rates for the first time, gold actually does well in a rate hike environment. And gold started to rally. We had about a 2-week rally before the Fed started raising rates. And then Russia invaded Ukraine. Then gold spiked, which we all know is a geopolitical move. It's a false signal. It comes right back down. But it put a lot of noise in the signal that gold should have been getting and should have been rising into the Fed's rate hikes. Then the Fed came out and was much more determined and much more hawkish than people had really expected. And rightly so, given the inflation numbers we were getting. But that also put a damper on gold. And then you have these algo traders who, as soon as the 10-year yield pops or the dollar index pops, and that's a sell signal. And we saw that, last Friday, we saw that gold was immediately sold off on the CPI number, $20. But then we had buying coming in that lifted it up again, and it rose about $25 on the day. So that was very encouraging. And of course, here today, gold's down significantly. And why? There's a lot of, today in particular, the 10-year yield again spiked. So we are battling that perception that rising yields are negative for gold. But in fact, we're in a situation where it's really irrelevant because we still have very negative real yields because the inflation rate is so high. And I think the Fed is powerless to really fight inflation.
Right. We've talked about that before. Ultimately, they are going to be powerless. But for now, the Fed does seem to be, powering forward to the extent that they can. I don't know if we can pinpoint when is the breaking point, but can you talk about things that would indicate we're getting there?
Yeah, I've been maintaining that when the Fed would get to 2% on the Fed funds rate, that would imply a level of interest costs on the federal debt that would equate to about $1 trillion a year in annual debt service payments, just interest on the federal debt. And I think that would be kind of a political breaking point. And I expected when they were going to hike rates, it would take about a year for them to get to 2% on the Fed funds rate. When the last rate hike cycle, beginning in December of 2015, they were hiking at the rate of 1/4 point a year. So now they're doing 2 years of rate hikes in a single meeting. They will get to 2% on the Fed funds rate most likely by August. And then it will take some time for those interest rate, the interest rate on the federal debt to kind of adjust and this cost to be realized. But I think it's going to be sooner. Instead of, say, 18 months like I would have predicted, it could be 6 months or less. So I'm hopeful that sometime in the fall, it's going to be kind of our time to see gold react, see the Fed start to get some headwinds, and we may see that long-awaited rally in gold begin. So I'm looking at the summer's doldrums as being kind of a good buying opportunity if you have a long-term horizon.
Right. And, we're definitely used to seeing that kind of activity in the summer. But so after that, perhaps we see this breakout point for gold. On the flip side, right now we've seen all this turmoil in, the general stock market. Does that then also intensify?
Yeah, it is. And I think we have more. And I've been saying people kind of, calm down, but we had a bunch of handful of 1,000-point drops. There was very serious sell-offs in the stock market in April and May, and And since the Fed really started on this rate hike campaign, and gold would get sold off because these were liquidity vacuums, liquidity events. People were getting margin calls. They had to sell anything and everything. But as it went on, the reaction in gold got less and less. And then, the last one we saw, gold actually closed up. Now it's down again today, but as we speak. But I think gold will not be affected as much going forward because the people that are selling gold to meet margin calls have sold all their gold by this point. So the speculators, the hedge funds, and the like, they don't really hold gold that much. So we're at a good base now, and I'm optimistic that gold will not be affected as much.
And for you, this is a question that I'm asking many people lately. Do you think we're heading toward a recession?
I think it's very likely. The technical definition of a recession is 2 successive quarters of negative growth. Well, we already have one for the first quarter. The second quarter, the Atlanta's GDP now gauge is at its lowest level yet and headed downward. So I think the last reading was about 0.9% positive growth. So we're very close. We're kind of on the razor's edge there. If we have negative growth then for this quarter, then that's the technical definition of a recession. I don't understand how a lot of these pundits are saying, well, we may have a recession in 2023. If we have a recession, it's going to happen right now. We're going to get through that door very quickly. I don't think it's down the road. I think we're on the verge of it, and that's right now.
Right. And okay, so today we have a lot of unprecedented circumstances, and I hear people say that makes it very hard to make predictions. Although at the same time, we do have people comparing what's going on right now to the 1970s, 1980s. Yeah. What comparison would you make if you were going to compare now to some previous time?
I really do think it's unprecedented. People talk about it being like the 1970s. Well, the two big differences we had, when we had the inflation of the 1970s, they were able to kill it off. And two reasons why they could is they had Paul Volcker as Fed chairman. He's not around anymore, and there's nobody who resembles him in temperament or anything else. The other thing is the debt load today is so much greater. We cannot, just a simple math, we cannot raise interest rates like they were able to do in the 1970s. In the 1970s, the federal debt was about 30% of GDP. Today, it's over 130%. So it's just, you can't do it. The debt precludes that.
Okay, let's talk about what's going on in the gold equities right now. I think maybe general market circumstances are making people hesitant to jump in there, but perhaps that means there are opportunities. Is there anything you would highlight?
Yeah, I would. Right now, you can buy solid companies with real resources, some with economics on them, some even in development, and get a good feeling that if the market just normalizes, those stocks will be trading 3 to 4 times the levels they are today. So you can, with much less risk, get positions in companies that present opportunities that would be similar to what a junior discovery play would offer, with much more risk. So I would emphasize right now going out and finding those companies that have very large proven deposits that have just been slaughtered by the market and are well capitalized. Look at share structure, look at upcoming catalysts, things like that. But if they have the ounces in the ground and they're selling at a fourth of where they should be in any kind of a decent market, then those are the kinds of opportunities I would focus on right now.
Okay, so that's one avenue people can pursue. I think right now one of the other things that I'm seeing going on is people are looking for safety.
Yeah.
We know there's gold and silver. You can go down those streets if you want to find safety. Are there any other areas that you would point to as this is a safe place?
Well, I don't know so much for safety, but for long-term potential, I'd say I really like copper. I like all of the base metals, but I think the bullish case for copper is particularly compelling, and good copper plays. But I also caution people that you're not going to get a move in, say, copper or base metal plays or any of the other associated metals or minerals unless there is an underlying bull market in gold and silver. That's what brings the investment interest to the junior mining sector. And you have to have that first.
All right. Is there any final words or pieces of advice that you would leave the audience with?
patience, I guess. Patience,
it's a hard
more
one.
patience, yes.
Yeah.
And it's not the kind of advice that, people like to hear or I like to give, because frankly, I've been giving it for a while. But I have seen worse. I have seen worse where the macro situation, the market was at the bottom, the macro situation was not that supportive. If you look at 1999, 2000, the double bottom at around $250 in the gold price, that was depressing for people in this space. Right now, the macro picture is remarkably in our favor. It's just the markets are not cooperating, and we're getting so much volatility and so much uncertainty, and a lot of people getting hurt. The long-term case is going to benefit the precious metals, though, and I think it's where you want to be for the longer term.
Okay, well, we'll try to exercise patience. I hope people can hang on a little bit longer.
Great.
Okay. Well, once again, I'm Charlotte McLeod with the Investing News Network, and this is Brien Lundin with Gold Newsletter.